Greetings, everyone. The walking wounded are in the house. Today, we're going to talk about issues and anomalies because in real estate, as we know, everything goes perfectly.
Yeah.
Right?
Because issues are anomalies, right?
Yes. Anyway, more right after this. I have such a mouthful of teeth.
That's exactly what I was thinking about. I was like, man, you have such a pretty smile, Bill. Those are really
And they're
white.
all still his.
Yeah.
It's a shame.
That's a good thing.
Yeah. Okay. So thank you so much for joining us on the Real Estate Investor Show. Hard money for real estate investors. We are Carolina Capital Management, private lenders for real estate investors in the Southeast. If you're interested in if you are interested and want us to take a look at one of your projects, go to carolinahardmoney.com and click on the Apply Now tab. If you're not interested, don't.
And if you would like to invest money passively, you can tell them where to click.
Oh, I thought you were going to.
Yeah.
I'm just helping you get through it, man.
Yeah,
Thank
we
you.
sell notes.
Just
All
dribbling and passing.
Click
Yeah.
on the Accredited Investor tab. Don't forget to like, share, subscribe, hit the bell, and don't forget about Wednesdays with Wendy. Wendy devotes 30 minutes per person on Wednesdays. Talk about anything real estate. Take advantage. There's her link to get on her calendar. She's usually booked up a couple of months in advance. We also have a question, comment, nasty replies over on the right or left side of your screen or underneath, depending on what platform you're viewing us from, because we are on many platforms. They just can't get rid of us.
Just what we're not looking for is the dating sites to be put on there.
Yeah. Yeah.
Yep. See, we're on Rumble even. So before I forget, Wendy is hosting a webinar for Invest Her at 1:00 this afternoon.
Today.
Yep.
Mm-hmm. And it's free.
That's a really good one. Underwriting in today's market. You do not want to miss that. With everything changing how it is, it's going to be some good insight on how to look at properties and look at loans, just kind of look at real estate in general.
And what we're doing to change, you know?
Mm-hmm. Yeah.
Yeah. And just because it's free, don't think it's not valuable.
Thank you.
Well, it's very valuable.
That's right.
No, it's part of giving back. It's part of, helping others rise to the top.
That's right. That's all I got there.
Being in business, do you want an educated consumer or do you want people that are going to waste your time because they don't know enough?
Well, it depends on what I'm selling.
I want an educated consumer
Yes.
at every turn.
So this is why we do what we do. It's not, yes, we want to give back. Don't get me wrong. We want to see everyone lifted up.
Mm-hmm.
But also, I'm slightly lazy. And it's a lot less effort when, we're not having to constantly explain the small stuff. If we can educate them on the front end, not only are the clients, investors going to be a lot more satisfied with what they get.
Is that our camera getting ready to go out of power?
Yes.
Okay, you want to go fix it while we talk?
All right, go ahead.
Oh, man.
Nothing but the best for us, right?
Yeah, I tell you what. Bill set this up. I don't think Thea did it.
Well, you want to talk about breaking news today?
Yeah. Can we throw in a little bit of news?
And get seasick at the same time.
We've got breaking news.
This is so breaking that this Wow.
Okay, so our camera's out, but we're still here, so you can talk.
Okay.
You can hear us,
guys,
right, Scott?
This is
Yes.
this is peculiar, but so we want to talk about multifamily real quick. Multifamily, we have seen rents go down year or month over month for the last 4 to 6 months, and we will continue to see that happen. When we say
But
go,
not everywhere, right?
most places, but yeah, not everywhere. And it's the rate of falling doesn't mean they're not. It's such a weird thing to say. It doesn't mean they're still not rising. They're just not rising as fast. So the rate of appreciation is just slowing. And what's going to keep that bolstered up before it hits flat, or even it's not going to go negative. It might hit flat in some markets. Interest rates are coming down. Now they will go back up. They will. But we still have a strong jobs market right now. Like, it's really strong. So that's still holding those up. And there's not enough inventory for people to buy. So rentals are still very strong. We wanted to talk about, like, where is the new place that everyone's buying? The Midwest. That's exactly
right. I have a really good friend. I was on Jim Ingersoll's Inner Circle call yesterday. Yeah. And Jeff Chikakachachi, I can't ever say his name. Anyway, he is a lender in Wisconsin. And he is kicking butt. He's having the best year he's ever had, and his December is just through the roof, he said.
Yeah. I mean, people follow affordability. There are some predictions that are made for rates, speaking of affordability, for next year. Many people believe that the 30-year mortgage is going to hit 8% next year, and then level out and then fall and probably land somewhere around 6%, maybe 5.25%, 5.5% for that 15-year fixed as well. So, we're going to see that rise in Q1 and then slowly taper off. I thought it was interesting. One of the economists made a point to say, no housing bubble will occur. It's like, thank you for someone saying that. The other piece is, it's what Wendy does a lot of is Airbnb, which is crushing it right now.
Yeah.
Airbnb just doing a partnership with apartment owners,
yes,
so that they can rent, tenants can sublease their apartments up to 180 days. And the owners of those apartments who allow that to happen get up to 20% of Airbnb's profit, which is a great incentive.
It is. Yeah. It really is. And what's really funny is so many of the smaller towns are kind of getting on a bandwagon to try and keep Airbnb or short-term rentals from being available in their community. Hotels have a lot to do with that are nearby, because they think that they're taking away their business. But it's, even here in Rock Hill, we've had a battle trying to get them to just be sensible about some of the things that they're requiring us to do.
I think one of the Airbnb owners here in town is suing the city.
Yes, they are. We're all part of that group. So we're doing the best we can to keep, we're happy to pay occupancy tax and business taxes and everything we need to do to keep it going. But they're like asking us to get approval from people that are within 500 feet in both directions, behind us, in front of us, beside us.
Do they verify this?
Yeah, they want every year get an approval from people that live there that it's okay to have a short-term
So
rental.
basically what you're doing is you're setting yourself to have to pay the people around you.
Yeah, that's a lot of pizza coupons.
Yeah.
It's ridiculous. And most short-term rentals bring up the value of the neighborhood, because we have to keep it a lot nicer than the average Joe just to get bookings. And
people don't want to rent a rundown place.
We've got to keep our yards up. It's crazy.
Well,
anyway, I digress.
Hotels are losing a little business to the families because they need bigger spaces.
Right.
But they're not losing business to most business travelers, because at a lot of times they're going to events that are at the hotels. And the only time they're typically going to stay in an Airbnb is if they're taking, several people and they need a little bit more room.
Well, what events do you go to at the La Quinta?
My,
And we
my
just
point
had,
is, it's all about convenience.
Yeah.
Convenience and cost.
yeah, we just went to a funeral in Philadelphia and had 11 people just in our local little family that traveled up there, rented a 6-bedroom, 6,000 square foot short-term rental. And yes, we had a party on Saturday night with, I don't know, 70 people that were just our
It
relatives.
wasn't 70.
It was.
I
You
wa-
needed to
it
count
was-
the little cousins.
Yeah,
He
more
was
like
drinking.
45.
He doesn't know. We had a great time. And the Airbnb person commented on how clean we left the house.
Oh, nice.
She was
Nice.
very pleased, but no neighbors complained. We kept it down and
Yeah, good stuff.
it was nice.
Even with all the bodies in the front yard.
Before I forget, just wanted to mention some of the fastest slowdowns we've seen in home prices are Austin, Texas, Boise, Idaho.
All the bubble markets.
Yeah,
that-
that's all quick.
Yeah.
But the top, let me see, the highest recorded gains in home prices for 2022. South Carolina's number 2.
Yay. We're number 2.
Florida's number
We're
1.
number 2.
And what was it? North Carolina and Georgia tied for 3rd,
Wow.
which is all places that we lend.
Yeah. Tell all your
Um,
friends.
Yeah. So it's
That's awesome.
The Southeast. Now, with those home price gains, that's a great thing. But with that comes the opposite side is that these markets are going to see
Stagnation.
stagnation much more quickly than others because they rose so fast.
Yeah.
I would add a caveat to the Florida market, however, that parts of the Florida market are not going to have that because of the lack of housing, because of the hurricane and all the damaged
Yeah.
homes that are there.
Yeah.
Sure.
There's still going to be a big need for housing because the storm eliminated a lot of it.
Yeah.
Yeah. There's
We lost
exceptions
one.
to everything.
Yeah.
Awesome. All right. Well, that's all I have.
What do you have?
Now let's talk about anomalies.
I can't not hear that quote.
Well,
Oh, brother, we're
every
2
time
weeks from
I
everywhere.
hear the word anomaly, Bill always says it's a geographic anomaly. This place is
2 weeks from everywhere.
2 weeks from everywhere.
That's right.
Love that quote.
Best movie ever.
Um,
I need some pomade from here.
so here's the deal. Year to date, S&P 500 is down 17.46%. NASDAQ is down 29.59%, and the Dow is down 7.55%. That's year to date.
That's
Sounds
pretty deep.
solid.
Yeah.
So the anomaly is that you have people that
Still investing in
are
it.
still staying in the market. Well, they're not looking for alternatives. Now,
Yeah.
a lot of times it's because they don't know any better.
Yeah.
They have no idea what an alternative is and that they can get into a fund. They don't have to buy the house themselves and maintain it.
And I do want to, like if you're in like Tesla or Walmart or something, like you're probably, even if there is a slight loss, you're probably going to stay in it because in the next 10, 20 years, do we think that they're going to be around? Probably.
Yeah. I would say so.
I understand staying in that. The higher, riskier stuff that you're in, more fintech, tech. I mean, that's risky. And I don't understand why people are still in that.
And generally, your growth equity stuff, you need to be out of. You need to be in something that's producing an income. And unfortunately, most of the stuff that produces an income in the market is going to be really low yielding right now.
Yeah.
So real estate, we believe, is always going to be the safest, risk-averse return on your money.
What's the difference between safest and risk averse?
I'm just throwing them both in there. Just covering my bases.
Love it. Yeah, no, I mean, real estate, I mean, we talk about it, all the time. You get cash flow, appreciation, and depreciation.
Mhm.
Like you get the best of everything in the stock market. What's the NASDAQ? Negative 29 and a half.
29 and a half.
Yeah, that's not sexy.
And I'm really glad you brought up the depreciation. People don't really take advantage of the depreciation that is available to you, especially with the cost segregation, even on the single family housing.
Yeah, if it has to be a high enough number where it makes sense. Like I'll give you an example. I've got 6 houses all together in Gastonia. That makes sense for cost segregation because you can do it on all of them together.
Actually, when you report them, you can't.
They're on the same parcel.
There you go.
So
There
I
you
can.
go.
Exceptions to everything.
But here's the thing. I've got a guy actually that's going to be talking on Sonrisers in January. They have a cost segregation tool. And it's $450. And I wish I had it. I shouldn't be talking without being able to show you what that tool is.
You can go to Sonrisers though.
Yeah, you can go to Sonrisers. That's right. I'll put it on that Facebook page what that tool is, how you can get to it. So it's $450 for the tool. It costs you $450 for each house that you do, $450. And what it does is it allows you to fill out a form and put all the different things you have to see if it's worth it for you to do the cost segregation on that particular house.
Yeah.
And if it is, you give it to your that's when you buy the report.
Yeah.
And you give it to your CPA so that they can change that the way that they're filing for your.
And all it does is it just speeds up the what you can depreciate on the property.
Right. And it really works for short-term rental properties because you also have furniture in there that you're able to.
Furniture wears out really quick.
Yeah, it sure does.
Or,
and it's 100% bonus. I mean, you get a bonus instant depreciation on that. So it's well worth looking into.
Yeah.
To take advantage of that. And I mean, that's what in times like this, when, we're seeing maybe some rents decrease or stagnate, prices aren't, you're not having a, big equity buy on things that you're doing. You really need to take advantage of the tools that are there, legally there for you to use.
Right.
They call them loopholes, but a loophole sounds like it's a cheating. It's not. It's using the laws as they're written to be able to take those discounts. And if you're a landlord and you're doing your own taxes, stop it. You're being stupid. Because the money you think you're saving is you could get so much more back if you do this correctly.
Yep.
And really, that's what it's. And people say, well, I have just have to add it in when I sell it. You don't add 100% back of what you depreciate. It's there's
a calculation.
Yeah, there's a calculation to it, and it's a lot less than what you're taking off. But you want. And here's another great thing is, if you can't use all the depreciation in that year, you can carry it over and use that the next year or the next year after that. So
the lesson here is stop stepping over dimes to pick up nickels.
That's exactly right. That's stepping over dollars to pick up nickels, because having a good person that does your taxes.
First of all, you're good at real estate or trying to get good at real estate. Get a professional to do your taxes.
And your accounting and your books.
Because as convenient as TurboTax is, it is not made for us.
That's right.
Made for
the
a
average
W-2 person that doesn't have really anything else going. It could be a self-employed person, but it's they don't own properties.
Yeah. That's right. In fact, not this Friday, but next Friday on Sonrisers, which is that 7:30 a.m. meeting that we do every Friday, I have a tax preparer, a CPA that's going to be on there. And this girl is smart. Her name's Pauline Yin. She is really, really smart. And I'm really looking forward to having her on there. She's going to be talking about things that we can do at the last minute before the year is out for us to be able to have deductions.
Timely,
so you don't want to miss that.
Yeah.
That's good, because I hate those dumb CPAs. Glad you have a smart one.
Well, what's another? I mean, this market is an anomaly.
Yeah.
I mean, isn't it? I mean,
unprecedented. It really is. You like that word?
Oh, God, I love that word. Yeah,
it really is.
When was the last time that we saw inflation this high, inventory this low in real estate, and also a job market this strong? It's the weirdest thing.
It's just a pull in every direction.
Well, I think
you always know when Bill's going to say something.
Clearing away.
I'm giving you a heads up. Coming in.
He's coming in hot.
I think after the first quarter, you're going to see a lot more companies starting to lay off.
Yeah, I think so too.
Because they have a certain margin they need to maintain, these larger corporations. And labor is the last thing they cut. because, it's important to them.
Yeah.
Yeah.
And, but at the same time, they have to, their obligation is to shareholders. So when you see those margins starting to shrink going into the first and second quarters, you're going to see job cuts.
And why are those margins shrinking? Is it because people are buying less? Maybe. Or is it because debt is now so expensive they can't use it to buy back their own stock and inflate their stock prices?
Well,
I don't know.
They said that heard yesterday that mortgage applications are down over 40%
Mhm.
from this time last year.
But they did a slight uptick,
Well,
like 1% from month over month.
The thing to remember is most of the mortgages that we saw weren't just purchases. We had a huge refinance boom going on.
Oh yeah.
But there's a lot of people that were hired to take that, weight off. And, we're seeing a lot of people being let go from that as well.
Yeah.
That's
So-
going to flood the market.
What can you guys do in your businesses to prepare for issues and anomalies in environments like this?
You stick your head in the sand.
Number one is that you make sure that you are as efficient as possible in your business. So go through all your bills every month, because you can really get into those subscription stuff
Oh,
that
they'll weigh
you're not
you down.
really using.
Mm-hmm.
Yeah.
And make sure that you're getting the best and the most benefit out of those before you continue with those subscriptions.
We did that as a company about 3 or 4 years ago, probably even 4 years ago. $16,000 we saved ourselves for a year.
2019, it was 16. It was almost $17,000.
That's crazy.
Yeah,
That's
really,
crazy.
every month we pick out a certain amount of stuff that we're doing and make sure that we're still utilizing it.
Right.
Yeah.
And so we keep up with that.
And if you have your own portfolio of real estate, please break out your P&Ls by property. Make sure that you have everything recorded by property, because as we, everything for the last 3-4 years has been easy.
One could be
Like,
dragging you down.
You just have them all in a pool and everything looks golden.
Mhm.
But you need to analyze each one, because you need to know which one to let go and which ones to keep.
Right.
You might have a ton of equity in this one, but it's your best one. It's performing the highest. Maybe you don't want to sell that one.
No, you leverage that one.
Yeah. So
and then you get rid of the ones that are dragging, and then you can use the leverage to buy ones that might perform.
Well, and then people are complaining too. Well, the interest rates are too high for me to refinance. So start looking for 2-year loans, 3-year loans, the ones that we know they're going to have a prepay. Make sure you understand the prepay and how that works. But it's only going to be for a short term, because we really believe that rates will come down a little.
We do.
And there'll be more programs that are offered. That's, I think, the thing that we're missing the most right now is that all those programs that were available to investors are really shrinking and disappearing. So that's the thing we need to keep our eye on is making sure that those DSCR loans are available.
Now, I mean, and the consensus between most economists is that the average for next year's interest rates are going to be right around 7.5%.
It's not going down much, is it?
And that's just the average for the whole year.
Yeah.
So when you have an investor loan, you can go ahead and tack on 1.5 to 2 points or 2% on top of that. So you know that you're going to be at 9.5%.
Yeah, not much lower than we are in hard money.
It's not. Right? And so just know that and use that underwriting and moving forward for your margins, because please do not underwrite on a basis of something potentially going down.
Right.
Underwrite for
what
for what you know. And
that's right.
I'm ultra conservative when it comes to that. Like when I underwrite a property to buy, if it doesn't cash flow at 12% interest only, I won't buy it.
Yeah.
I won't. Now, do we get rates lower than that? Of course we do. But you want to know that if something happens, can this thing at least cover itself at 12%?
That's right.
So
I will have to hand it to Silver Hill Financial, part of Bayview. Their 30-year fixed rate program for a commercial property back in the before 2008 was a game changer, because as a business owner, as a property owner, you know what your expenses are going to be going forward.
Yeah.
And the typical loan before that was a balloon note of 3, 5, 7 years. And what always happens, because it's Murphy's Law, is when it's time for you to refinance, that's when the economy is going to be
right.
down, and you don't have enough money to show that you're making enough money to cover the payment, which
Yeah.
means you're going to have to bring a chunk of change to
close.
refinance your property again.
Yeah.
So knowing what you have is always best.
And another piece, just, if, real estate, if you own rentals, that's fine. If you have a business, you need to be knowing what your production is per person and what your EBITDA is per person.
Explain what EBITDA stands for.
Earnings before taxes, interest, and depreciation and amortization. So I might have mixed them all up.
It's before all your junk is taken out.
So it's your gross, it's your earnings before, you pay interest, you calculate depreciation or amortization, all of those things, and taxes.
So gross.
Kind of.
Mostly gross.
Not really. I mean, because it has all of your operational expenses in there. So you want to know what that is per person, and you want to be tracking that, because if you see that dip and tracking it every month, if you see that dip, that could be the warning signs that, hey, we, either productivity is down or the market's changing and we're not getting in what we need to get in to cover what we have. So,
That's right.
So it really needs to be broken down per person.
And if you have money sitting in the bank, don't sit it in the bank. Let it earn some interest. Put it in a fund. Ours is great, doing really well.
I'm kind of
Would
fond
love
of
to
it.
have more money, but there are several good funds out there that are solid, that are earning, I hate to say it, double digits. But you don't be afraid and just leave it in the bank. Let it earn some money.
Yeah.
Buy notes, do what you need to do to get some income coming in off of it.
We're not saying, you have your 6 months or 3 months reserves. Yeah. Keep that cash.
Absolutely.
For sure. Keep that cash. If you're hoarding all this other money, it's actually costing you money to hold it.
Don't work out of fear.
Here's the thing. There's a lot of people that are sitting on their money because they're waiting for the next opportunity that they missed out on in 2008. And they want to keep that powder dry so they can jump on these deals.
2008 is not happening again, guys.
The problem with that is while you're waiting for the great deal to come, you're going backwards,
earning zero
and
or less.
There are always opportunities that will come available. So if you're going to put it into a fund, and even if that fund has a lockup period for a certain amount of time,
ask them.
Ask
them if you can get it out early, what the penalties are. Is it worth it?
Some of them won't, but it doesn't matter, because you're in the long run, you're going to end up losing more than you're going to gain waiting for the home run to come.
That's right.
So, again, my personal opinion.
Steady wins a race.
My personal opinion is 2008 is not happening again. And I think there's a lot of people hoarding and out of fear. And if you want to do that, that's fine.
Fear will get you nowhere.
But yeah, you're missing out on earning money right now and setting up your wealth for the future.
That's right.
I'm laughing because we sound like the stockbrokers.
Don't
get out now.
No,
you're going to miss the upswing.
I'm not saying just get into anything. You got to be smart and do your due diligence. But
if you can find a real estate opportunity that is paying above inflation, that's not the same as being in the market. Well, it goes down and then you have to write it back up again. This is steady income,
right,
or distribution, so that it's going to be beating inflation,
right.
Yeah,
and that's what you want to do. You want to beat inflation.
Yeah, we want to beat inflation. I saw somewhere where turnkeys are down pretty significantly. People buying turnkeys.
Why are they afraid to buy property?
They're probably not cash flowing the way they were.
I think
everybody got used to.
The issue is, and I was having a conversation with some people at a mastermind these last few days. All these properties for these property management companies that do turnkeys, they were purchased and underwritten and pushed through their system based off of
Low rates.
numbers 6 months, a year, 18 months ago.
Right.
Mhm.
And now, as they're exiting out, the numbers just don't make
Yeah.
sense for a lot of people.
Yeah.
So there might be some good opportunities to buy properties, to even turnkeys, and maybe a slightly, I say discount, but I guess at or below market, which is below what they thought market was.
Right.
You know,
Right.
Well, even if your numbers aren't what you thought they were going to be, your rents will eventually catch up.
always the optimist, Bill. I love that about you.
I do too. We got to wrap it up. I got to go.
Oh, well, since it's all about Wendy, thank you guys for, wait a minute. Do we have any other, first of all, don't forget about the webinar she's going to, thank you, Tyler. Yeah.
And thanks for the referral, Tyler. I just talked to somebody. Who
So
sent me.
don't forget about the webinar at 1:00. Do we have that link anywhere?
Yeah, they put it in
Yeah, they
the-
put it
Okay,
up there.
perfect.
Yeah.
And then are you going to be anywhere else?
Yeah, I've got Raleigh on January 12th. That's right. I forgot about that. That's the Saturday, QuestCon.
This Saturday?
This
Wow.
Saturday.
Okay, thank you.
It's Friday and Saturday, actually.
There's,
It'll be well worth signing up for.
and you get a discount code, Carolina 15.
Bill, you and I will be in Miami or Fort
Yeah, we're
Lauderdale?
going to be at the Family Office Club in Fort Lauderdale.
Taking another hit for the team.
Yeah.
You guys are just too much. Thank you so much.
Yeah. The next one's in Costa Rica, so it pains me to go.
And then the TRIA event.
Oh yeah, and Wendy, you're talking at this one, right?
Oh yeah, the self-storage in April in Las Vegas. I'm excited about that.
She is just a world traveler. All right, folks. Sorry.
Well, thanks for bearing with us, and
We're kind of the walking wounded right now. So thank you so much for joining us on the Real Estate Investor Show, Hard Money for Real Estate Investors. We are Carolina Capital Management, private lenders in the Southeast for real estate professionals. If you'd like us to take a look at one of your projects, go to carolinahardmoney.com. Click on the Apply Now tab. If you are a passive investor looking for passive returns, go to our accredited investor tab. Do the share and like thing, will you?
Please remember to like, share, subscribe, hit the bell,
hit that
tell
bell.
all your friends.
And don't forget about Wednesdays with Wendy.
Yeah.
All right, you guys have a great week.
Bye. Thanks, Tom.